Now, there are biases that are innate, which you can't get away from, like fear and greed, and the big players use that to their advantage. We're talking about those same financial institutions that throw hundreds of millions of dollars inside of a market. Mostly we talk about mutual funds and hedge funds. A lot of these financial institutions, they can't get out all at once. They'll take out a part of their position and the stock price will go down, and they'll pump the stock up again after a short panic. We understand that the entire game is manipulated. Hey guys, welcome back to the After Hours. I'm the A-Tail Beast, and today we're going to talk about the funds. When we talk about funds, we're talking about financial institutions. And one of the things you have to really narrow in on is the game of stocks. When we look at a chart with Japanese candlesticks, the chart is all over the place with volatility, red and blue candles. With a lot of these areas, it's going to be tested more than once. In those specific areas, they have names. Some of you might know it as support or resistance. Others might know it as a supply zone or a demand zone. But whenever we look at indicators or lines on the chart, one of the most important trade signals you can look at is actually the volume. The reason for that is because of institutions. We're talking about those same financial institutions that throw hundreds of millions of dollars inside of a market. When we talk about why won't a financial institution actively trade in a penny stock? Well, it's because they have too much money. They have a problem with scalability and liquidity. Liquidity is pretty much volume. We're talking about the flow of money into a stock. And based off of how profitable that company is, it's going to change that stock price. Well, ultimately, it's all down to supply and demand. And what's in supply? Shares. And who has the ability to buy the most shares? The financial institutions. Mostly, we talk about mutual funds and hedge funds. There's other financial institutions out there, especially when they back these funds. We won't list them now, but if you want to, you can list them in the comments, just to break it down a bit. When we talk about mutual funds and hedge funds, when it comes to the incentive for these funds, depending on if you're talking about a mutual fund, we can see the manager getting about 1% of the funds that they raised with their investors. When we look at these funds, they're not regulated by the SEC. The SEC is there to protect the public from themselves. But if you have enough income to be inside of a hedge fund, or if you have enough education inside of finance in general, and it qualifies you to be in a hedge fund, well, the SEC thinks they don't need to have your back. You got your own. Now, when it comes to the manager of these funds, they're a little all over the place, especially with their motivations. They're mostly focused on marketing, making the fund as big as possible. Remember, trading is a long-term game. And because it's a long-term game and a very addicting game, it's probably going to be around for a while.
Interested in trading like Steven Dux? It all starts with choosing the right broker. Dux Trading has partnered with Centerpoint Securities to supercharge your trading journey. By joining Centerpoint Securities through Dux Trading, you can unlock CP Edge, a suite of top-tier trading tools valued at over $6,000 right at your fingertips. Gain an edge in your trading with real-time scanners, cutting-edge news, and a personalized trading journal. Experience trading like never before, with superior short inventory, dedicated support, buttery smooth trade execution, and the opportunity to earn interest on any of your idle funds. Plus, enjoy competitive pricing that suits your trading style. Ready to elevate your trading? Simply click the link in the description below to get started. Now, let's dive back into the content.
When we talk about 90% of the people in the market fail, you have to understand, we're talking about long term. Anyone can get lucky in a heads or tails game, because that's kind of what it is. A lot of people come to the market with a bias that doesn't help them in their trading. Now, there are biases that are innate, which you can't get away from, like fear and greed. And the big players use that to their advantage. They'll pump up a stock, but they won't use all the money they have to pump up a stock. You'll see on the 1 minute candle or the 5 minute candle, a large influx of volume. This can just be one big player initiating a move, and the rest of the candle is the retail chasing. The retail that chases, they're greedy, which leads to a parabolic or minimum, a spike. And at some point, you're going to see the big position that was the initial position that the financial institution had. They want to take it out. When they do that, that means it's hitting the supply zone. This is where all the sellers come in. Now, because of the large position size, buying millions of shares, a lot of these financial institutions, they can't get out all at once. They'll take out a part of their position and the stock price will go down, and they'll pump the stock up again after a short panic. And once it goes up again, it usually goes back to the same supply zone. Now, to the common trader, this probably looks like resistance, and they do this on repeat. Now, this is not a pump and dump, but the concept is there. There's a lot of stocks that are pre-bought, stocks that were slowly bought weeks ago. When they do this, they buy most of the supply of the stock. And when it comes to the remaining supply of the stock, that's probably 10%, 20%. We understand that the entire game is manipulated. Now, last week we traded NXPL and RENT. Now, fast forward to next week, after I broke my winning streak, we had the same type of situation where I lost, and the loss was egged on by my losing streak. We're talking about WISA. Now, this was a bounce short, and so was ZCMD. It had layers of resistance. Only 4 million candles on the daily chart. This one, and this one. And it was spread from 350 all the way to 2. Now, those 3 layers of resistance acted as a heavy resistance for a bounce short. And what it looks like on the intraday is even crazier, because we had confirmations that the previous day in the after hours, it went up to 350. And then in the aftermarket, it stopped at 2 times. This was a clear topping pattern, lower high and double tops, maybe even a triple top. At that point, the pullback at the open is something that you should have chased. But in my case, I just saw how small one of the individual resistance was on the daily chart. So I treated it like a gap up short. I wanted it to go into the safest spot for me, which was 350, or minimum at least 3, because I don't like trading tickers that are below 3. They're cheap, and cheap attracts volume, and too much volume on a cheap ticker, that can just be a person with a decent amount of money. Earlier that week, we saw this go from $2 all the way up to $10, which is crazy, but it was something we could work with, especially when it came back up for a bounce short. This wasn't the best bounce short because there wasn't much time for the overhead resistance to activate. If anything, it was a little too widespread. We wanted more bag holders to be trapped, but because it happened only the day after, so there wasn't as much bag holders as we wanted. Minimum, we wanted it to go to 8. But because we were in our feelings again, we went around 720. We expected this max to go to 7, which makes this range really tight. Most people are around 550 because things got neutralized there for 1 day. We normally want that neutralized level to go on for 2 or even 3 days to make sure bag holders are there. That demand zone is heavy. But in this case, we only waited for it to go up to 7. We wanted it to go as close as possible back to the supply zone that we're used to, which was closer to $9. And if we really wanted to get picky, it could be as high as $11. The bare minimum we wanted was 8. And that's because on the day where we had 200 million volume, we saw the first sign of the big player getting out, and that was at 850. Now, on that morning, I went in around 720. Now, I did this a lot earlier than I should have, and I ended up taking a loss. Now, when I took that loss, I took it around 780 because that's my max risk. It hit my max risk and I got out, which is a part of the plan. And I could have went back in because it did hit my original mark. But at that point, I don't have any confidence to trade anymore because I hit my max loss. And if I continue to trade, I will continue to break my discipline, which is going to make me lose even more money in the long run. With the WISA, this wasn't the highest quality bounce short because of the tight range, and that tight range ended up showing itself throughout the day. We did have the stock go up to 8, then came back down to 6. It didn't even go all the way down to low 6 like I thought it would. It only stopped mid 6 and went right back up to 850. Now, after it came back down, then it went below 6. So I had a solid 2, maybe even 3 opportunities for me to get back in on this. But at that point, I was done for the day. I had my one try because of my losing streak. And so if I continued to trade, even if I won that money, it wouldn't be good money. We want to make money from our plan. The stock market is just a money transfer tool from the long-term investors to the short-term investors that are used as liquidity. Now, short-term investors, they'll pump up the stock, but only after the investors start the initial move. And then when you put the retail volume on top of the initial move, they'll wait to dump the stock. And because of the money limitations, which is a good problem for them, they might have to do it several times, which leads to a ranging market. Now, beginner traders, they usually focus on something silly. You only really need to focus on what's really important. We're not talking about focus on win rate or making money. If anything, if you have the wrong focus, it's going to lead you to overtrading, oversizing, and any form of FOMO. Remember, we're trying to be efficient when taking loose money out of the market. Now, there's algorithms out there that are backed by money. They're doing the same thing. You can do the same thing with your own individual hedge fund account. All right, guys, that's all I got for you today. If you like what you saw, hit the like and subscribe button, and I'll see you in the next video. Peace.